Hi, I'm Christina Trauthwein, VP of Content and Partnerships with Hotel Business, and I'm sitting to interview Ryan Bosch, and he's a principal at Arriba Capital. Hi.
Yeah, happy to be here.
Great. So let's start with this. We're seeing significant shifts in hotel financing since 2024. How are traditional banks and private lenders repositioning themselves in the market for 2025?
I think the biggest thing that we're seeing right now, last year, banks were muted, right? We had regulatory pressures, higher cost of capital, and borrowing for banks. And so we saw them kind of exit the market, retreat from the market. I think it was the lowest percentage we've seen of bank participation in the overall financing activity in hotel capital markets. Coming into 2025, we think that we're going to see an increased share from banks. So we're seeing banks re-enter the market, actively originate, and I think there's going to be more capital availability. In terms of private debt funds, we're seeing a proliferation of more and more private debt funds every week that want to focus on hotel originations, which is good for the market. There's a lot of capital availability, and there's so much capital chasing deals right now. I think it's compressing spread. So it's a good time to be borrowing hotel capital.
Okay, so as the lending landscape evolves, what new opportunities are you seeing for borrowers to structure their capital stacks?
I think more than ever, especially coming into this year, there's a lot of opportunity to creatively structure a capital stack. Some examples would be C-PACE financing. We're seeing even the brands get creative beyond key money on how they could participate in the capital stack and execution. EB5 capital, especially in rural development areas. So there's a lot of different programs and ways to skin the cat on the capital stack. And I think hotel developers that are actively engaging on those and researching them and getting creative are going to find a lot of unique ways to structure the capital stack going into this year.
We're talking a lot about opportunities right now. I'm going to switch that up a little bit. So with more private lenders entering the market, what common pitfalls should borrowers be watching for?
I think the biggest thing borrowers should be watching for if they're doing business with private debt funds coming into this year is there's a lot more structure to the loans, right? So really understanding what your prepayment penalties are, loan covenants, reserve requirements, different type of DSCR, debt yield thresholds. There's just a lot more to it with private debt funds and a lot more to watch out for. So I think that's the biggest thing if you're coming from traditionally borrowing from a regional local bank. There's just going to be not as much structure to that loan. So making sure you understand everything you're agreeing to on these private debt fund loans is imperative.
Okay. Ryan, how should borrowers in different markets approach the financing?
I think there's always going to be more capital availability in your big urban core primary markets. If you're a borrower and you're in a tertiary market, a smaller rural market, you got to get a little bit more creative on your capital sources. Those markets are going to be driven primarily by, local regional banks, but there is a proliferation, like we said earlier, EB5 financing, especially for rural designated areas, USDA loans. So I think you got to be creative if you're outside of a large primary core market.
Let's finish with this, Ryan. What advice would you give borrowers about managing their lender relationships in the evolving landscape?
I think more than anything, it's building diversity in your banking relationships and in your lender relationships. If your typical go-to is you have 2-3 regional local banks that you've worked with, something happens like it did last year, right? Where we ran into this a lot, where those banks were on the sidelines, no longer actively lending. And now you have no relationship lenders and you've got to go out and build a new network of capital sources. So I think it's always important to have some diversity in your mix and not just have all your eggs in one basket.
I think it's great advice.
Yeah.
Thank you so much for your time.
No, thanks for having me.
Thanks.